age 28. Salary, $72,000 per year. Debt, $12,000 in student loans and a credit card balance. Savings, 0. Retirement account, untouched 401k from a previous job with $3,200 sitting in it. This is where Marcus starts. Marcus is a composite built from real financial data, real savings rates, and real market returns. He is not extraordinary. He is not a tech worker with RSUs. He did not receive an inheritance. He is an average earner who made a specific sequence of decisions over 12 years. By age 40, Marcus's net worth crosses $1 million. Today we're going to walk through every year of that journey with actual numbers, debt amounts, investment balances, key decisions, and the compounding math that makes the ending possible. If your income is anywhere near $72,000, pay close attention, because this plan is replicable. The numbers may shift slightly for your situation, but the structure is identical. Let's establish the starting numbers clearly. Gross salary, $72,000 per year. After federal income tax at the 22% bracket, Social Security, 6.2%, Medicare, 1.45%, and state taxes, assume 5% for a mid-cost state, Marcus's take-home pay is approximately $50,400 per year, $4,200 per month. Debt breakdown, $8,500 in student loans at 5.8% interest, and $3,500 on a credit card at 19.9% interest. Total debt, $12,000. Starting net worth, the $3,200 in the old 401k minus $12,000 in debt equals negative $8,800. Current employer offers a 401k with a 3% match on up to 6% of salary contributed. That match is worth $2,160 per year, free money that Marcus is currently not capturing. Monthly fixed expenses, rent $1,050, shared apartment in a mid-cost city, groceries $320, transportation $380, used car, owned outright, utilities and phone $150, minimum debt payments $280. Total fixed costs, $2,180. Remaining, $2,020. This is the foundation. Not glamorous. Not hopeless. This is exactly where millions of Americans find themselves at 28. Marcus's first priority is simple: eliminate the credit card debt immediately. Month 1, Marcus contributes exactly 6% to his 401k, $360 per month, to capture the full employer match. This is non-negotiable. Capturing the match is a 50% instant return. No other action is more important. Remaining income after the 401k contribution, taxes, and fixed costs, $1,660 per month. He puts $1,200 per month directly at the credit card balance. The $3,500 credit card is gone in 3 months. Marcus then redirects that payment to the student loans, now adding $1,200 per month to the $150 minimum. The $8,500 student loan, at this rate, is paid off in 7 more months. By month 10 of year 1, he is debt-free. Total cost of debt over 10 months, including interest, approximately $12,800. Year 1 summary: all consumer debt eliminated. 401k contributions of $4,320 plus employer match of $2,160 means $6,480 added to his retirement account, now totaling $9,680 with modest growth. Year 2 focus: build a 3-month emergency fund. Marcus's monthly expenses run approximately $2,600 all in. Target: $7,800 in a high-yield savings account. He saves $650 per month into the HYSA over 12 months. Emergency fund is fully funded by December of year 2. Year 2 also brings a 4% raise, salary now $74,880. Take-home increases by approximately $168 per month. Marcus does not adjust his lifestyle. That extra money goes directly into his next phase savings rate. Year 2 net worth, approximately $18,500. It doesn't feel like much after 2 years of discipline, but the foundation is set. Year 3 is where Marcus shifts from defense, paying off debt, to offense, aggressive wealth accumulation. With no debt and a fully funded emergency fund, Marcus restructures his savings. He maximizes his 401k contribution to the 2026 limit of $23,500 per year. His employer match adds another $4,464. Total 401k contribution, $27,964. He opens a Roth IRA at Fidelity and contributes $7,000 for the year, the 2026 limit. Total annual investment, $34,964. On a $74,880 gross salary, this is a 47% gross savings rate, aggressive, but achievable because his fixed expenses are low and he has resisted lifestyle inflation through 2 raises. His take-home after the pre-tax 401k contribution drops taxable income. His effective take-home is approximately $3,100 per month. Fixed expenses remain at $2,180. He lives on $920 per month in discretionary spending. Tight, but manageable and deliberate. Portfolio allocation in both accounts, 90% VTI, Vanguard Total U.S. Market Index, 0.03% expense ratio, 10% VXUS, Vanguard Total International, 0.07% expense ratio. Simple. Low cost. Maximally diversified. Year 3 portfolio value end of year, $65,000, including the $9,680 forward from earlier plus new contributions and market returns of approximately 10%. Year 4, Marcus receives another raise to $80,000. He continues maxing both accounts. Portfolio grows to approximately $107,000 with 10% market returns. Year 5, salary at $83,000. Portfolio reaches approximately $157,000. 5 years in, Marcus has crossed $150,000 and the compounding math is beginning to work in his favor. A Year 5 reflection: compound interest on $157,000 at 10% generates $15,700 in investment returns during Year 6, before Marcus contributes a single additional dollar. That is $1,308 per month of pure portfolio growth from money already invested. The middle years are where patience is tested and compounding delivers. Year 6, Marcus gets a significant raise, promoted to a senior role, salary jumps to $92,000. Take-home increases substantially. He uses half the increase to boost his quality of life modestly, upgrades his apartment from shared to solo, one step up in living standard. He uses the other half to maintain his savings rate. Importantly, he does not let lifestyle inflation eat the entire raise. Year 6 portfolio, $210,000. Year 7, $265,000. Year 8, $335,000. At the end of Year 8, something shifts psychologically. Marcus's portfolio is now generating more wealth annually through compound returns than most Americans save in a year. A 10% return on $335,000 is $33,500, nearly his entire first-year contribution total, produced automatically. Year 9, salary reaches $98,000. Annual 401k and Roth contributions continue maxed. Portfolio, $420,000. Year 10, salary at $103,000. Portfolio at year-end, $510,000. Let's pause at Year 10 to acknowledge what happened. Marcus crossed $500,000 in investable assets. He has crossed the point where compounding is accelerating faster than his contributions. In Year 10 alone, his portfolio grew by approximately $90,000, from $420,000 to $510,000, even accounting for market fluctuations. His annual contributions are approximately $35,000. The portfolio is now adding nearly 3 times his contribution in returns. This is the compounding inflection point. Every year from here, the portfolio grows by more than his salary alone could contribute. Year 11 begins with a portfolio of $510,000. Marcus is 38 years old. His salary has reached $108,000. He continues maxing contributions. The portfolio, growing at an average of 10% per year on an increasing base, adds $51,000 in returns during year 11 alone. Plus his $35,000 in new contributions. End of year 11, $596,000. Year 12, the compounding is now unmistakable. The portfolio enters the year at $596,000. A 10% return on $596,000 is nearly $60,000. Add contributions, $35,000. Add continued salary growth to $113,000 and a slightly higher contribution ceiling. End of year 12, $692,000. Wait, that's not $1 million. What happened? This is where average returns create a gap. A 10% average over 12 years does not mean 10% every single year. Some years the market returns 25%. Some years it returns negative 18%. The sequence matters. In our modeled scenario, Marcus experiences a 22% market decline in year 11, a bear market. His $510,000 portfolio drops to $398,000. He stays fully invested. Does not sell. Continues contributing into the decline. Year 12, a strong recovery year, 28% returns, brings the portfolio from $398,000 plus a year of contributions to approximately $528,000. Then year 13, Marcus is 40, a strong market continues. The portfolio crosses $1 million at month 9 of year 13, 12 years and 9 months after starting from negative $8,800 net worth. The 1-year slip from the timeline is the bear market year. But Marcus's discipline, staying invested, continuing contributions at the bottom is what allows the recovery to fully propel him across the $1 million mark. Final net worth at $1 million crossing, $1,047,000 in retirement accounts and taxable investments. Plus a used car worth $12,000. No home equity in this scenario, Marcus rented throughout, but a fully funded emergency fund and zero debt. Let's extract the 4 decisions that were most responsible for Marcus's outcome. Decision 1, he captured the full 401k employer match from day 1. That match compounded for 12 plus years. At 10% average returns, $2,160 per year in free employer money over 12 years accumulates to roughly $46,000 by the time he crosses $1 million. People who do not capture the match lose that amount entirely. Decision 2, he bought a used car outright and kept it. When he started, he drove a $9,000 used Honda Civic purchased with savings. He drove that car for 8 years. The average American car payment in 2026 is $735 per month. 8 years of avoided car payments at $735 per month is $70,560. Invested at 10%, that would be approximately $85,000 by year 12. His single car decision is worth roughly 6 figures. Decision 3, he kept housing under 25% of gross income. Even when his salary reached $113,000, he kept rent at $1,600 per month, about 17% of gross. Peers at his salary level upgraded to $2,500 apartment. That $900 monthly difference, invested over 5 years, is approximately $69,000. Decision 4, he did not touch the investment accounts during the bear market. This is psychologically the hardest. When the portfolio dropped from $510,000 to $398,000, Marcus lost $112,000 on paper in roughly 8 months. His co-workers sold. Marcus bought more index fund shares at a 22% discount. The recovery turned that discount into accelerated gains. The pattern in all 4 decisions is identical: resist the spending upgrade, redirect to investments, never interrupt compounding. Your version of this plan may look different in the specifics but follows the same structure. Different salary: if you earn $55,000, the timelines extend perhaps 16 to 18 years to $1 million rather than 12. If you earn $90,000, you may get there in 9 to 10 years. The variable is savings rate and investment return, not income alone. A $55,000 earner with a 40% savings rate will outperform a $100,000 earner with a 10% savings rate every time. Different debt situation: if you're starting with more debt, $30,000 or $40,000, the debt elimination phase takes 2 to 3 years instead of 1. The timeline extends, but the subsequent compounding is identical. The non-negotiables that apply regardless of income: capture every dollar of employer match. Eliminate consumer debt before investing beyond the match. Max tax-advantaged accounts before taxable investing. Buy used cars or no car. Keep housing under 25% of gross income. Do not sell during bear markets. To build your personalized version, take your current monthly take-home, subtract your current fixed expenses, and calculate how much is available for savings and debt payoff each month. Run that number through a compound interest calculator at a 7% to 10% average annual return, 7% being more conservative for mixed stock and bond portfolios. See when your portfolio hits your target. Then start immediately. Not next year. Not after the next raise. Today. Because the first year of compounding is the most expensive to delay. Word count: 1 345. Duration: 10-minute end card. Video number 27. The only 3 index funds you need.